Well, the title of this blog is a question. And the title is The Best Passive Alternative Investment is Notes? Question mark. True or false? So I've been watching private money for a long time. Let's talk about how private money shifted to alternative investments. Financial planners started calling it alts after 2008. And let's start continuing to watch how it progressed. So there were 5 million rental properties foreclosed on in 2008. 5 million. They were sold through the banks. They were called REO, real estate owned. And a lot of real estate promoters had access to a lot of this inventory of these foreclosed houses, and they sold these houses, but they sold them primarily to investors, not consumers. They weren't predominantly sold to people that were going to live in the house. They were predominantly sold to people that were using it as an investment. Well, why were they buying real estate? Most of these people didn't have a real estate background. Well, let me tell you what happened. What happened is these people were buying real estate because it was an alternative to traditional stocks and bonds, right? Now, let's fast forward. From 2008, the real estate market crashes. Real estate goes way down, right? Great time to go buy a rental. Then the market starts going up, up, up. Here we go, right? Higher than it was last time, right? Now, what happens? What happens is in a 10-year period from 2020, go back to 2010, there's 18 million rental houses more than there were in 2010, 10 years ago. But you'll also understand something, because if you're in our loop, I'll bet you do, and that is rental property owners, landlords, have a tolerance or an intolerance. So the intolerance in the market means that a lot of those people, even before the COVID situation, were sort of intolerant to their rental property situation, right? So I look for this to be the most likely candidate to start bailing out if they see any sign of the real estate market slipping. People say there's no inventory, but let me tell you something. There's 18 million rental landlords more than there were 10 years ago. And let me tell you something, they may not be committed to work all the way through a cycle. So there's going to be opportunities buying those properties from them, specifically buying these properties and using creative finance positions and letting them owner finance equity for you. Or, number 2, I see them bringing their money out of rental property and into the note space. Now, this shouldn't be some giant new surprise to you, but I'm trying to draw some clarity of where this money came from, what it invested in, what it didn't like about the investment, and now what it sees as a continual alternative investment, where you're saying, oh no, they're just going to go back and jump. The stock market's all hot again and everything's cool, right? They're going to jump back in the stock market. The experts don't say that. And I don't say that. So I say that we know specifically, we were sitting on more dry cash than we've ever seen in the history of the United States right after the COVID situation. A friend of mine who runs an IRA administration company says his people are bringing in cash into their self-directed retirement account at a rate they've never seen before. Right? So now, what are we going to do with this pent-up, uninvested money? You'll hear me call it dry cash. If we position ourselves right in the creative financing world, we can use that money to be a low loan-to-value first mortgage, a private mortgage on a house that we buy on terms, get the seller to carry a second. I think we can use that money to go recapitalize on a note we have, either a note we bought or a note we generated. To recapitalize, we can either borrow money against the note or we can even sell a partial against the note. But this private capital is looking for a safe place, not to earn a high return, but to earn a confidence that they're going to get their money back with some return. Market condition, I believe like no other, this is lights out where we're going. Start positioning yourself. If you're not, be positioning yourself to go be developing and nurturing burnt out landlords that are definitely going to be a victim of the virus in a way that, well, it's not predicted in the news, but it's in real life, because we know these landlords who bought rental property aren't as enamored with them a few years later as they were when they bought them. Okay? It doesn't mean everybody's going to sell, but it definitely means that there's a percentage of landlords that will sell and do different things and will be bringing cash and property equity to the market that is going to produce a terrific opportunity for us. You see, we get to be the problem solver again. Hope this helps. See you later. Hey, for those of you guys that are still watching, hey, remember, like this. YouTube loves for you to like what I'm saying, and I love for you to like it too. And subscribe. Now, a lot of people ask us on a regular basis, what do I do? How do I progress? How do I learn more about what Eddie is talking about? Well, right here in the band, here's some information we'd love to share with you. We've got great articles, great stories, great training of all types that show you how to position yourself in the market and position yourself for the market ahead. We'd love to hear from you. Let's take action. Let's go kill this business that's going to be ahead of us, because the opportunity is going to be incredible. See you later.